Okay, so let's continue with another adjustment for account receivable, which is bad debts. Alright, so bad debt is the amount of money that cannot be recovered or collected from a receivable. Okay, so this is known as bad debt. The possible reason for bad debts, alright, are death, bankruptcy, or no response at all from the receivables, even after reminders are sent to them. Right, so the company has decided to recognize this amount as bad debts. All right, so what is the treatment for bad debt? It is to reduce both AFDD account and account receivable. All right, so how to reduce AFDD account? So AFDD account, basically we have a credit balance, so to reduce this one we are going to debit AFDD, and then we are going to credit account receivable. Okay, as simple as that. All right, so let's look at one example. Okay, so I'm going to use the same example as before. All right, for year 3, except that for year 3 in this example I will add a bad debts. All right, okay, so year example. Okay, in year 3, account receivables, account receivable as at 31st December is 48,900. Allowance for doubtful debt as at 1st January is 1350. Okay, so this is the opening balance. All right. During the year, one of the customers owing 700 was not able to pay the debt due to bankruptcy. The business decided to write off the amount as bad debts. The business provided 2% EFDD on the remaining balance of account receivable for every year. Okay, on the remaining balance of account receivable. Why on the remaining balance? Okay, because first, we have to adjust for the bad debts, all right, which will affect our account receivable. Okay, so you are required to calculate AFDD for year 3, journalize the transaction, prepare an extract, an extract of SOPL and SOFP. Okay, so the first step is to make adjustment for bad debts. All right, so what is the adjustment for bad debts? Debit AFDD, meaning that we are going to reduce our AFDD accounts by 700, and also to reduce account receivable by 700, where you credit account receivable 700. So if I were to prepare the account receivable, it will look like this. Okay, year 3 balance BD is 48,900. Okay, from the balance that have been given in the question. Okay, and then so you're going to credit, you're going to credit account receivable. So this is account receivable. Okay, on the credit side you're going to record this 700. All right, and the detail is AFDD, while in AFDD account we have been given, in AFDD account we have been given a balance BD, all right, or opening balance of 1350. So AFDD always has credit balance. Okay, so balance BD 1350. All right, and then you debit when you prepare the adjustment, for bad debts. All right, you debit AFDD by 700. So this 700 you show it here. Okay, so account receivable, 700 in AFDD. Okay, so this is debit, so you debit 700, for account receivable. All right, step number 2, because in the question, the business provided 2% EFDD. Other than the bad debts, that we have recognized in the year, we still provide for allowance for doubtful debt, for the balance of account receivable. All right, so the difference between bad debts and allowance for doubtful debt is that bad debt, it is confirmed that you cannot collect or recover the amount of money from your receivables. Allowance for doubtful debt is only an estimation, it's only a possibility, that we might not be able to collect the amount of money. All right, but still there is a possibility that we can collect that amount of money. Okay, but bad debt is confirmed that you cannot collect that money from your account receivable, so that's why you credit directly to your account receivable the amount of 700 of bad debts. All right. Okay, so if we have bad debts for the year, all right, when we calculate our allowance for doubtful debt, okay, we're going to use the same estimation, which is 2%. Okay, so 2% times, okay, 48,900, okay, the opening balance for accounts receivable, minus 700, which is the bad debts. All right, or if you prepare the account for account receivable, then you take this balance, okay, 48,200. It will be the same thing. Okay, it will be the same thing. Okay, so now the balance, okay, the balance CD for AFDD is 964. Okay, so 964 is your balance CD, okay, which you are going to show it here. Balance CD 964. All right, so here. Okay, so now we have 1, 2, 3. The next thing that you have to do is, okay, number 4 is to total both debit and credit. So pick the higher total as the total. So the higher total at this point, okay, where you have included number 1, number 2, number 3 in AFDD account. So we do have only on the debit side we have account receivable and balance CD. On the debit side we have only balance BD. All right, so what is the total? Okay, at this point, all right, at this point the total on the debit side is 700 plus 964 equal to 1664. On the credit side we have only 1350. So pick the higher total as the total for your debit and credit. So the higher total is 1664. Okay, so 1664, all right, so 1664 minus 1350, so you have a difference of 314 doubtful debt. Right, so if it is on the credit side here, then this is an increase in allowance for doubtful debt, so this is to be treated as an expense. Okay, all right, or you may simply use the formula, but now the formula has changed, okay, where we have to include also the bad debts, okay, that we have recognized earlier. Okay, so closing balance AFDD, okay, closing balance AFDD minus bad debt, okay, and then closing balance AFDD plus, okay, bad debt minus opening balance AFDD. Okay, so you will get the same amount as the one that you get here from the account 314. Okay, so let's look at the formula. If we use the formula instead of you prepare an account for AFDD, okay, so doubtful debt is equal to 964 plus 700 the bad debt, this is balance CD, so minus the balance BD 1350, so equal to 314. Okay, so the difference is here positive, so this is an increase. So when it is an increase, it is an expense. Okay, so how do we show this in statement of profit or loss and statement of financial position? Okay, in the statement of profit or loss, because we have identified this bad debt as expense, all right, so we show it here under expense, doubtful debt. All right, whereas for balance CD, okay, we're going to show it here in the statement of financial position, okay, under the category of current asset. So we have account receivable. Okay, so this account receivable is the balance CD, okay, 48,200, this one, or the net amount. Okay, if you did not prepare an account, okay, so it comes from 48,900 minus, okay, minus 700. Okay, so you get 48,200. It comes from your previous adjusting entry. Okay, when you prepare an adjustment for bad debt, when you decide to credit account receivable, it means that you're going to reduce your account receivable. So 48,200 is the net account receivable. Okay, last AFDD, okay, this one, 964. All right, or the amount that you have computed above, okay, 964. All right, so that is your balance CD. Okay, so that balance CD will appear in your statement of financial position. okay, will be reported here. Less AFDD 964. Therefore, okay, the net account receivable is 47236. Okay, so this is what happened when you have bad debt recognized, okay, for that year. All right. After some time, let's say for example, okay, let's say for example, from the example here, okay, from the example above, okay, related to bad debts. All right, so this bad debt happened because the customer was not able to pay the debt due to his or her bankruptcy. All right, however, it is common that a person may come out from this situation, okay, from the bankruptcy. Okay, so they may decide to make the payment, okay, for the amount of money that they owe, right, to the business. So the amount of money recovered, okay, so bad debt, that will be recorded as bad debt recovered. Okay, you receive the money from the customer that you have previously recognized as bad debts. All right, okay, so it is possible that one day they come back and they make the payment, so you are going to record this as bad debts recovered. Okay, so bad debt recovered is the amount of money recovered or received from the receivables after the amount has been written off as bad debt in the past. Okay, so the accounting treatment for bad debts recovered is, okay, first you have to reinstate the receivable because we have to show that this amount of money comes from which account receivable. Okay, even though in the past we may have written off the accounts, okay, due to bad debts, okay, we may credit the account receivable, okay, but now we are going to reinstate. So we are going to debit account receivables, credit bad debts recovered. All right, and then we are going to record the amount. So record the payment, debit cash or bank, credit account receivables. Okay, and then to recognize bad debt recovered as other income. Okay, so bad debt recovered will be put as other income in the statement of profit or loss. So debit bad debts recovered, credit statement of profit or loss. Okay, so let's look at one example. Okay, so in year 10, a customer whose account was previously written off as bad debt in year 3 paid his debt of 700. Okay, so previously we already write off this account, this amount of 700 from, okay, we have removed this amount, okay, from account receivable. So now, okay, after sometimes, okay, after many years, all right, after that, okay, a customer came back and then paid his debt of 700. So generalize the transaction and then prepare an extract of SOPL. Okay, so step 1 is to reinstate the account receivable. Debit account receivable 700. Okay, credit bad debts recovered. Okay, 700. So you recreate an account receivable for this person. Okay, for this customer or account receivable. Okay, so debit meaning that, okay, debit 700. Okay, bad debts recovered in account receivable. Next, credit bad debts recovered meaning account bad debts recovered. Okay, credit side. Okay, so account receivable. Okay, the details is account receivable. Okay, so that's it. All right, and then step 2, record the payment received. Okay, so debit bank. So in bank account, you debit because you want to show that you have received money. Okay, from account receivable. Then you credit account receivable. So here. Okay, credit account receivable 700. So this 700 you credit. Okay, you credit and then bank. The details is bank. Okay, and then recognize the amount as other income. Okay, and then this amount of account receivable. Okay, then you transfer to statement of profit or loss. Okay, so in statement of profit or loss, this amount will be recognized as other income. So under category of other income, if you have received money, okay, for bad debts recovered, okay, you're going to show it here, bad debts recovered, okay, 700. All right, okay, all right, so that's all for the adjustments, okay, for account receivable. Okay, so we have allowance for doubtful debt. All right, we have doubtful debts. All right, we have bad debts, and then we have bad debts recovered. All right, okay.